for the fourth session of the day, which is what is corrective AI and how it can improve your investment decisions. We will be joined by Dr. Ernest Chan from Ontario, Canada. Hello, Dr. Chan. Are you here with us? How are you doing today?
Hi, Kishidi. Thank you for inviting me. I'm great. I'm doing great. Very excited to be here.
Great. If you can turn on your camera, all of us can see you.
Sure.
Hey there. Wonderful. I can see you now.
Great,
Okay,
great.
so a quick introduction. I think Dr. Chan needs no introduction, but still, just a few words about Dr. Chan. So Dr. Chan is the founder and CEO of PredictNow.ai and is a managing member of QTS Capital Management. And he has worked for various investment banks, including Morgan Stanley, Credit Suisse, Maple, and hedge funds like Maple Ridge Millennium Partners, and since 1997. And Dr. Chan received his PhD in physics from Cornell University and was a member of IBM's Human Language Technologies group before joining the financial industry. He was a co-founder and principal of EXP Capital Management, a Chicago-based investment firm. And Dr. Chan is also the author of Quantitative Trading: How to Build Your Own Algo Trading Business, Algorithmic Trading, Winning Strategies, and the Rationale. And his third and the latest book is on machine trading, deploying computer algorithms to conquer the markets. So with that said, Dr. Chan, I will be passing the presentation rights to you. And now I guess, yeah, and you'll be able to share your screen.
Thank you very much. Let me share my screen. Okay, I hope everybody can see my presentation. Thank you again for inviting me, Kashidi, and I'm very excited to talk about corrective AI and also another technique that we invented called conditional portfolio optimization with you. So as the title suggests, corrective AI is AI that improves and corrects human decisions or decisions made by simple quantitative systems. The reason we coined this term is that we believe that AI is more effective in correcting decisions than in making them from scratch. A very quick analogy with self-driving cars. So despite the many billions and advances that are made in this in the self-driving car industry, Tesla and others, you don't see our streets filled with them yet. In fact, they are still trying to sort out some bugs. Even Tesla recommend that you put your hands on the steering wheel when you are in a Tesla. So it's not quite there yet. On the other hand, there is hardly a car these days, a new car that you can buy these days that is not fully loaded with assisted driving technology, things such as fatigue detection, things such as collision avoidance or lane change assistance, and so on and so forth. Those technologies can be called, is what we would call corrective AI in the in the automobile industry. And similarly, the same concept can be applied to asset management and trading. That's for sure. And that is what we are going to talk about. We do not recommend using AI to directly make trading or investment decisions. Instead, we recommend that you use it to correct decisions that you make via other system or algorithms. Now, to give a little bit of a background on this point of view, on this application, many of you who are perhaps familiar with AI know that it undergone many winters, the so-called AI winters, where no progress seems to be made, and applications were stalled. Similarly, for financial AI or financial machine learning, there is there's a winter, and that winter extends from 2000, when I first almost when I first started to apply AI to finance, to 2018, when Dr. Lopez Prado published his book, Advances in Financial Machine Learning. I call that the financial AI winter because that's the period where most AI and ML applications in trading fail. They fail because of overfitting, for example, or because of reflexivity, namely that the AI system that correctly identified an arbitrage opportunity in the past would have made that but that arbitrage opportunity disappear in the future because there are too many people also discover the same signal. So signal to noise ratio remains small, and whatever signal that you can detect are the signals that have already been arbitraged away. That's what we call reflexivity. It's a name coined by George Soros. And then finally, there are regime changes. Whatever, as you know, the financial market is far from being a stationary system. It undergoes many different environmental changes in the going from in the late 1990s, the dot-com era, to the crashes of the dot-com eras, to the sort of the recession following 2011, 2001, and then up to the financial crisis of the mortgage-induced crisis of 2008, and then a very long bull market following that until we are hit by COVID. You just cannot count how many times the market environment have changes. And so clearly, if your AI system is trained on just one of these regimes, and for example, your AI system pick up a signal that says buy low, buy on the dip, right? If your AI system is trained on, for example, 2019, you would have, I'm sorry, not 2019, 2021, you would, the AI system would discover that buy on dip always work. And then you apply this AI system to 2022, and it will be dead. It's a drastic change in regime. So that a lot of these, and Dr. Lopek Dipari, in fact, called that, gave talks that with title like the 7 reasons why most machine learning based hedge funds fail. And they fail because of these reasons and more. Okay, but in the same book, Dr. Lopek Dipari also pointed to a technique that can at least partially overcome this problem. And that technique he called meta labeling, and I call corrective AI, because corrective AI is something that most people outside of finance can understand, whereas meta labeling is perhaps a bit technical for a lot of the business people. So what corrective AI or meta labeling means is that instead of trying to use AI to learn to predict where the market go, and that turned out to be a very hard task, we want to use AI to learn from a private trading strategies or portfolios returns and use that to predict that strategy's return over the next period. Why is that going to be much more successful? Well, for one thing, this prediction cannot be arbitraged away. So reflexivity doesn't apply, right? Because I didn't tell you, even if you know the prediction of that AI system perfectly, how it applied to your competitor's strategy, you wouldn't be able to benefit from it because you don't know the base strategy of your competitor. You only know that your competitor might lose money tomorrow, might make money tomorrow, but that's nothing you can do about it. On the other hand, for your competitor, this is a very, very useful system because it can tell you if it says that it has high probability that the strategy will lose money, you don't have to trade it. The competitor doesn't have to trade it. And so, in the extremes, ideal situation, you would avoid every losing trade and just make the profitable trades, and you will have a Sharpe ratio of 10. You'll be the best trader ever, right? So corrective AI has this property that it cannot be arbitraged away, and that is one of the most important reasons why it can be more useful and more practical than the traditional way where AI is applied to trading and asset management. So now, of course, how does it make this kind of prediction? It is not enough just to learn from the strategy's past return. If it were that easy, anybody can do AI. AI and machine learning by its very nature, needs a large set of predictors, what we call features in the AI business. They could be things such as, so for example, you have a trading strategy that trade the S&P 500 futures. The predictors would include something much broader than S&P 500 future. It might include the returns of the oil futures. It might include the implied volatility of the bond market. It might include macroeconomic indicators such as CPI changes. It might include new sentiment on 10 most heavily traded stocks in the US market. It might include Twitter information from across the board. So you can imagine that even if the goal is just to predict your own strategy's return, the input is not just based on your own strategy. It has to be based on what generally is called big data. Hundreds, if not thousands, of inputs are necessary. And this is where AI gets complicated and difficult. It is very difficult for an individual trader to amass this number of predictors. It is not a matter of just create a few technical indicators and try to fit it into a machine learning algorithm. The machine learning algorithm itself is actually pretty easy. You can download it from Microsoft. You can download it from Facebook, Google. There are many websites that let you train a machine learning algorithm for free or for a very low cost. But the problem is that, what about the input? The input are hundreds or thousands of them, and that is where it becomes difficult to implement for individuals. Now, of course, I wouldn't be here if we haven't solved it for them. So my company, one of the reasons that we exist is that we have solved that problem for individual traders, because we have actually created these hundreds of predictors for our clients, and that overcome that problem. So the other well, okay, before I go on to the other technique that we invented, let me talk more about in detail how corrective AI can help strategy. So as I said, you train a machine learning system to predict your strategy's profitability, and what the precise output is, it is a number called the probability of profit. This probability of profit can be used to size your bets going forward, right? So if the probability of profit is very low, you might size your trade to be 0. You don't want to trade at all. If the probability of profit is high, you might go maximize your leverage. So, but probability of profit can be directly related to the capital allocation you apply, or the leverage you apply to your strategy. And this is a bit different from traditional risk management, because traditional risk management, things such as value at risk and so forth, are always based on basically just returns, right? You look at the probability distribution of returns in the past, and you say, well, there's 5% probability that your strategy is going to lose 1 standard deviation, something like that. But machine learning differs in the sense that it is not just looking at the return, because the returns, or the probability distribution of returns based on historical data, is a sort of just a one-dimensional view of your strategy. It is, in fact, you might call it static view. You are assuming that we don't care how the market regime changes. We don't care that today is very different macroeconomic environment. For example, today is an inflationary environment compared to 2019. I don't care. I just saying that this is a probability distribution from the last 10 years, and I would say that based on that last 10 years, it has a 5% chance that you're going to lose 20% of your portfolio. That's the traditional view of risk management. The view of risk management based on corrective AI that I described, on the other hand, take into account the regime implicitly, not explicitly. We won't say that, oh, today is an inflation regime, or today is a bullish regime, today is a volatile regime. We don't give a name to it. The regime is implicitly defined by these hundreds of features that monitor the market and the macroeconomic environment. And that's what helps Corrective AI to make a much more adaptive risk assessment of your strategy. It is not based on whatever happened in the last 10 years and it's likely to happen tomorrow. It is based on, well, we learned something from that line. Of course, machine learning still have to learn from the past. It doesn't have intuition about the future unless it learns from the past. But it learned a much higher dimensional understanding of the past. It is not just looking at the returns of the past. It looks at macro, like I say, macroeconomic variables. It looks at market variables, and it looks at many different market instruments, not just the instrument you're trading, to make an assessment of the risk based on this high dimensional understanding of the past. And that is much more powerful than traditional risk management. Okay, so that's Corrective AI. So I mentioned a little bit about regimes, and I said Corrective AI succeed where traditional risk management fail, and where traditional AI fail, because it was very good at not identifying regimes. So let me talk a little bit about what I meant by regimes. Now, when I mention regimes, many people have this notion of, oh, bullish and bearish regime, quiescent versus volatile regime, risk on versus risk off regime, inflationary versus deflation regime. Indeed, these are regimes that are well understood by economists, by traders. And these regimes, of course, affect every portfolio, whether it's a portfolio of stocks, of futures, of even a portfolio of trading strategies, no problem. They affect everything. And these regimes are pretty easy to identify. You say, when is the, in the past, what's the most recent bullish regime? I can tell you, the bullish regime is from 2020 June to maybe December 2021. Right? Everybody can agree that that is a bullish regime. Or what is a risk-on regime? Similarly, it's a similar period. And if you ask me, when does the most recent inflationary regime starts? I could say, well, the inflation regime start in let's say when January 2021, when the CPI index start to go up. So those are easily identifiable. They are visible. They are explicit regimes. But so that's why I say they're easy to identify a posteriori, after the fact. But they are very hard to predict. If I am able to predict inflation, I would be invited to be the Fed chairman, not Mr. Powell. Mr. Powell was unable to predict when the inflation is going to stop, right? He made several errors in the last few years. If I were so good in predicting inflation, I should be the Fed chairman. I wasn't. I don't imagine I would ever be invited to be the Fed chairman, because I probably is much worse than Mr. Powell is in predicting inflation. And similarly, if I can predict a bullish and bearish regime, I won't even be talking here. I would just be relaxing in Hawaii on a beach, because if I can predict a bullish regime, in contrast to identifying in the past, I would just trade 100 million of E-mini futures and I'll be done. There's no need to talk about it. I would keep it secret. The problem is, this kind of explicit regime is almost impossible to predict with any accuracy anyway. However, there are hidden regimes that is much harder to identify. For example, Robinhood traders buying call options on the GameStop, the articles, prime brokers liquidating, or even more subtle. Why is it that my strategies lose money in this period? Can anyone tell me why? And those regimes are kind of hard to identify. Unless you have the trading records articles, unless you have the trading records of every Robinhood trader, which, by the way, is private, right? You can't get hold of it. They are very hard to identify external by an external observer. You can only infer, there are a lot of small trades in call options. That's probably because of the Robinhood traders. But unless you are Robinhood CEO or the operations team, it's very hard to identify when do they suddenly discover buying call options on these kind of mini stocks. But interestingly, they are easy to predict because they have these telltale signs flashing all across the market, such as a lot of options activities going on the small cap stocks and so forth. They actually are easier to identify. I'm sorry, easier to predict than the explicit regimes that we talk about, such as bullish and bearish regime. Particularly easy to predict are regimes that only affect your own strategy, because your own strategy is unique and there are particular market circumstances that make it profitable or unprofitable. Maybe if your strategy is a short volatility strategy, and it is fairly easy to predict volatility compared to predicting return. So if you can predict that, if you use volatility as a variable and you predict that volatility will continue, which it usually does because of a clustering property, you could have predicted that you are in a regime because of increasing volatility that will be bad for your core short option strategy or short volatility strategy. So that's very interesting. That hidden regimes are hard to identify in a posteriori, but easier to predict going forward. And particular hidden regimes, as I said, that only affect your strategy, not a broad hidden regime that affect everybody. Because those regimes, even though other people might be able to identify it, is of no use to them. So they cannot be arbitraged away. That's the same idea, the lack of arbitrage. And now, so how do we identify this hidden regime? Traditionally, whenever you mention about hidden regime, they think about hidden Markov models, state space model. But I have tried it as hard as the next person to make hidden Markov model work. It doesn't work. It doesn't work because it is a very weak model. Again, the only inputs are prices or returns. Machine learning has greatly expanded the dimensionality of input. You are now using big data, hundreds, thousands of variables to try to predict these kind of hidden regimes. It is proven to be much more successful in predicting regimes, particularly hidden regimes, than the traditional time series state space models such as hidden Markov models. And in particular, they can handle a large amount of nonlinear interactions among the predictors and also among the predictors and the target variables. And so that is where the true power of machine learning comes about. So I talked so far about corrective AI, which is, to summarize, to learn from a portfolio's returns history, add big data, and to calculate the probability of profit. We use that probability of profit to optimize the overall leverage of a portfolio. And typically, the machine learning model that is used is a classification model. But there's another technique that we invented, which is even more powerful. It is what we call a conditional portfolio optimization technique. It also learns from a portfolio's return history. It also relies on big data captured in the form of hundreds of features, but it also captures the constituents return history of the portfolio. And the goal now is not just to predict the probability of profit, but the goal is to optimize the allocations to these constituents in order to maximize the Sharpe ratio. So instead of passively just saying, oh, I'm going to change the leverage of portfolio because it might be losing money today, I actually actively go inside the portfolio and change allocation of that portfolio. So you can think of it as a much more advanced use of Kelly formula, right? If you are familiar with Kelly formula, a basic use of Kelly formula is to determine the optimal leverage of a trading strategy or of a portfolio. That's what corrective AI can do, but with much more success because it uses big data. Conditional portfolio optimization is a more advanced use of Kelly formula. Kelly formula, remember, can not only optimize the leverage of a portfolio, but it can also optimize the allocation to the constituents of a portfolio. Kelly formula can take into account the covariance of returns of a portfolio and the expected return of the constituent to recommend a optimal allocation. In fact, I have shown in one of my previous blog posts that Kelly formula method of portfolio optimization, of capital allocation, is mathematically equivalent to Markowitz mean variance optimization. For some reason, this is not well known, but I have shown mathematically in one of my blog posts that that was the case. So here, what we have done, what PredictNow has done, is that we take it a step further. Not only we are able to maximize to optimize the allocation to the portfolio component using past return, but we can inject big data into this optimization, and the result is quite impressive, to be quite to be quite honest. So, but before we talk about the results, let's look at the three traditional portfolio optimization methods. The first one is risk parity, which is essentially treating all the constituents to have zero correlation, and we just allocate capital based on the inverse volatility. So that basically what risk parity means is that you allocate equal risk to each portfolio component. The second one is called minimum variance. Minimum variance means you do take into account the covariance of the returns, and then you use mean variance optimization to minimize the portfolio volatility. I will denote it in the next slide. I will show what is called an efficient frontier. And actually, why don't I show that? That's the efficient frontier, and here, this black point here is the minimum variance portfolio, right? At the leftmost edge. At the leftmost boundary of the efficient frontier is where the minimum volatility of the portfolio sits. Okay, but what most people are familiar with is the Markowitz mean variance portfolio. It maximizes the Sharpe ratio, as again making use of the covariance structure of the past returns. And what that portfolio, the resulting optimal portfolio, is often called a tangency portfolio. The tangency portfolio is the portfolio that has the maximum Sharpe ratio, and I denote that is here. This is the efficient frontier, and this might be the maximum Sharpe or the tangency portfolio. This is the portfolio that if you draw a straight line, let me draw it here. If you draw a straight line, which is what is called a tangent, from the risk-free rate, let's say this is the risk-free rate, RF, okay, RF. This is the risk-free rate, and if you draw a tangent from the risk-free rate to touch the efficient frontier, the place where it touches is the tangency portfolio, and it has the maximum Sharpe ratio. That's classical portfolio theory. You can find that in any textbook on portfolio theory. I don't need to belabor that. So these are the three sort of traditional methods of portfolio optimization. What we have done is that we go beyond that, because none of these methods account for regimes, right? They only use returns. Particularly, they only use the mean return and the covariance of return. They don't even use the entire return history. They don't even use the entire probability distribution of return, right? They only use this first and second order statistics of the return. And so they don't usually work very well. And furthermore, they don't account for regime change. You might think, well, let's do a walk forward optimization. We use the past year's return and constantly optimize our portfolio based on past year. Well, that kind of optimization usually doesn't work, maybe even work less well than if you use the 10 years of optimization. Because if you have been optimizing a portfolio based on 2021, you would have overweight tech stocks. You would have overweight Tesla, Amazon, and the Zoom, right? You know, everybody using Zoom, and that would have been disaster, or Instacart, or DoorDash, right? And then 2022 come, my goodness, everything, you know, even Shopify dropped 70% from the peak. So it would be a disaster if you use walk forward optimization based on past data, because none of these actually uses the context. It doesn't look at the inflation. It doesn't look at, hey, how would increasing interest rate affect tech company versus oil company? What about if the inflation, what about oil price? If it the oil price double. Does it really make sense to say that you should allocate more money to tech stock versus oil company? It doesn't make any sense, right? So, past returns are definitely no guarantee of future performance, and that is a very good illustration. The regime change between 2021 and 2022. On the other hand, AI can capture all that, because AI knows that when the oil price go up, chances are oil company stock will do better than tech stock. It's a no-brainer. How can you not even know that, right? It would ask the portfolio optimizer, and lo and behold, AI knows that. Machine learning can deal with that, and so it is a much more intuitively, it makes much more sense, this optimization method based on big data and machine learning, than the traditional portfolio optimization technique. Okay, so this is technique again that we call conditional portfolio optimization, because the conditional is that it is conditioned on the big data, it's conditioned on the macroeconomic and financial environment. It is not only based on past returns. It is conditioned on big data. It's been conditioned on the external environment. So all that sounds great, but does it actually work in practice? We apply it to many different portfolios. We apply it to S&P 500 portfolio, and comparing with Markowitz mean variance optimization, the Sharpe ratio improved by 3 times if you use CPO. You apply it to a crypto portfolio. It's not just the stock portfolio. You can apply it to crypto. You can apply it to many things. Crypto portfolio, it improved 3.8 times out of sample, the Sharpe ratio. If you apply it to a ETF, it is an ETF of tech stocks, particularly tech stock that has to do with metaverse. It's an ETF. It's a public data. It's not a. It's a and we apply the proper constraint. You might say, well, your optimization is impractical because it allocates all the capital to one stock. No, we impose the proper constraint, long only, and the stock weight is between 0.5% to 10%, and lo and behold, it improves the Sharpe ratio over their equal weight portfolio by 50% out of sample, and most importantly, it knows to switch to a defensive position during a bear market. It is remarkable. It knows to switch to less volatile stock when at the onset of a bear market. More to come. We applied to a client's forex portfolio with 7 trading strategies, and it improved the Sharpe ratio by 100% in out of sample test. We applied to a client stock portfolio with 7 US and 2 Canadian stocks, again long only, again with a proper constraint. It improved the Sharpe ratio 50%. The list goes on and on and on. So moreover, this optimization method, you do not have to maximize Sharpe. Maximizing Sharpe is the only thing that Markowitz can do, but based on CPO, based on conditional portfolio optimization, you do not have to maximize Sharpe. You can maximize the ESG rating, which is all the rage these days. You can also apply any kind of constraints to it. And we develop API to allow our clients to, in fact, experiment with different constraints that they want to apply to the portfolio. So now, again, and not only that it worked in our experiment, this technique had been vetted, by some of the most reputable machine learning researcher. For example, Dr. Joe Martin, who is Chief Digital Research Officer at the National Research Council, gave an in-depth interview with us, and we described CPO to him. And based on his approval or recommendation, we were admitted to the AI stream at the University of Toronto Creative Destruction Lab. So, I'm very excited about this technique. It improved our clients' profits and lower their risk, and it is proven to be a uniquely new invention in the AI field. And we have, therefore, PredictNow is in a position to market it to many enterprises. There are some of the largest financial services in the world are conducting tests based on our technique. So I'm very excited about talking about it here. But of course, none of this is possible without our amazing team in research and in data science and in quantitative analysis, and our engineering team that help us to implement it. So thank you to them, thank you to our team member, and thank you to the audience here for your patience in listening to me. And I'm certainly happy to answer any questions.
Wow, thank you for sharing your work and overall experience and knowledge with us, Dr. Chan. We will now start picking up questions from the audience. Please put your questions in the questions panel, everyone. And meanwhile, you do that, I would like to share that again about our anniversary sale. So starting tomorrow, we'll be offering 75% discount on all Quantra courses, and this offer will start early for all the conference attendees with the additional benefits. So attendees of this conference can avail additional 20% discount on top of the upcoming anniversary offer by applying coupon code 75 plus 20, which I have just shared. And this offer is only valid for next 7 hours. And I am also sharing a learning track, machine learning and deep learning in financial markets, that covers a few courses by Dr. Chan himself. So please feel free to explore them. And I will also share the questions with Dr. Chan. Let me just okay. All right. So yeah, I see. I'll start off with the first question. So the first question is by Tan. So Tan asked, with machine learning winter since with ML winter since 2000. So why many companies still use ML to find entry and exit for profitability?
Well, you might call it wishful thinking. So as Dr. Lopez said, most of them fail, but there's no reason not to try, right? If you fail the first time, you stop trying, you guarantee to be fail forever. But if you keep trying, maybe at some point you will find a way to win. So we do not fault them for trying.
Thank you, Dr. Chan. So, Tan, I hope that answers your question. Tan also had a follow-up question about in QuantInsti, are there EPAT course ready to prepare his students to be a quant trader? I think that's exactly what our EPAT course is all about. And Dr. Chan, do you want to share anything on this?
Oh, for sure, yes. I actually teach one course with QuantInsti. It's called the Quantitative Momentum course. We really have a deep dive into the futures market and the various momentum strategies, that the causes of momentum. And I think that if you have taken that course, you would have a much better understanding of the financial market than before the course.
Thank you, Dr. Chan. Tan, I hope you got your answer. The next question is by Srirang Yadav. So, how to effectively use ML and AI in trading and make good profits?
So just as I described, I do not recommend you to use it to generate trading signals, but I recommend you to use it for corrective AI, that is to say, compute the probability profit of your current trading strategy so that you can avoid the losing trades. A lot of people have sort of forgotten that risk management is actually the most important aspect of trading. Imagine if you can avoid all the losing trades, even if you have only a few profitable trades. Let's say you just make one profitable trade a year. Good enough. You just increase your leverage, and you can just trade for one day a year, and then take a full year vacation. That would be wonderful. So risk management is, in fact, the most important aspect of trading.
I hope that question is answered, Sriram. I think we are getting quite a few questions and interesting ones. So I'll pick this one by Frank. So Frank asked, could you expand on CPO, how it used the features to dynamically understand the macroeconomic environment Is it through the use of neural networks?
Well, the underlying machine learning algorithm is usually not important. Whether you use neural network or random forest or good Bayesian boosted decision tree or support factor machine, it's not that important, And what's most important is the inputs. So you need to find the massive number of inputs, and then with all those inputs, you can effectively try to predict the return of various capital allocations of a portfolio. So let's say you allocate most of the money to a tech stock. These big data will try to predict a return or Sharpe ratio based on that composition. On the other hand, it probably predict a return that is pretty low when you have rising oil price. On the other hand, if you overweight the portfolio on oil stock and some of your features are oil price change, it will most likely find that, oh, hey, most likely this portfolio will have high returns. So by making returns prediction on the portfolio level, given big data and given the portfolio composition, it has the ability to sort of pick out the best portfolio under each regime.
I hope, Frank, your question is answered. So on the inputs, again, the following question by Salim is on the same. So can we consider sentiment analysis a part of ML inputs?
Certainly you can. Yes, whatever data that you have your hands on, add that. Even the same data, you can apply various mathematical transformation, signal processing transformation into multiple different features. So just one raw data stream can result in multiple features, and you should add them all. I mean, merge them into your input features.
Great. So Salim, I hope your question is answered. The next question is also regarding CPO. So Gihad asks, are CPO models trained using deep learning or machine learning algorithms?
Yeah, that's similar to the question before. It does not matter what machine learning algorithm you use. It's the inputs that's important, not the training algorithm. So use your own favorite algorithm for training.
Okay. Okay. So Gihad, I hope your question is answered. The next question is by Nikita. Nikita asked the question on HFT. So could walk forward optimization be used for high frequency trading?
So walk forward optimization doesn't usually work, as I explained. Otherwise, we wouldn't be needing corrective AI and CPO.
Okay. There is a question specific to Indian and Japanese market. So Sundar asked, any current insights on or prediction about Indian and Japan markets using PredictNow.ai with respect to next 2 years?
No, we don't give market prediction. As I said, all the systems we develop are customized to your own strategy. You could be trading options on the Japanese market. You could be trading futures. You could be using a mean reversion strategy. You could be using momentum strategy. PredictNow.ai will learn from your strategy to make prediction. We do not make prediction about market. As I said, that is has been very unsuccessful for most practitioners. So we certainly don't want to follow in the same footsteps.
Okay. The next question is by Shubha, and the question is on the granularity of the data. So what is your recommendation for granularity of data? Daily, 4-hourly, hourly, etc.
Yeah, I think that because the main focus is on regime prediction, and regime actually doesn't change from minute to minute, right? Right now we have an inflation regime. We don't expect suddenly the inflation to go away 5 minutes from now. So I think the typical data frequency is daily, is sufficient.
Okay. This next question is from Rishikesh. Does corrective AI will take care of black swan events as well?
Yes, in fact, we have a lot of indicators that can predict back one. It's quite remarkable. We actually used this back in 2020, and before the market crash in the COVID, you can see the probability that it says it has a big market move to suddenly increase dramatically, and we were able to position ourselves to take advantage of that kind of market movement. It's quite remarkable how just monitoring the market and variables can tell us whether the tail event will happen. It actually worked surprisingly well for tail event prediction.
Okay. We have also got a few questions related to data. So this question by Pavel Fedorov is, I was wondering, could you comment on what data providers do you think are worth considering for algorithmic traders for real-time intraday live equity data, including for international equities, for example, Canada, in your experience?
Well, it depends on what kind of strategy you are trading. If you're trading like a 1-minute bar, any broker would provide you with live data that is suitable at a 1-minute bar. If, on the other hand, your strategy requires tick data, then as a retail trader, you probably can get it from like DTN, for example. I remember that I don't remember the subsidiary of DTN that can provide you with live tick data, but certainly better than the broker. But if you are interested in data that is a millisecond latency, then you probably have to subscribe directly from the exchange through one of the brokers. It gets very expensive very fast. So yeah, it's the best data provider. Very much depend on the latency of the trading strategy.
Okay. So I hope, Pavel, you got your answer. The next question is also regarding data. So how to get started with machine learning for financial data?
Well, if you check out our website, PredictNow.ai, that's a good way to start.
Yes. So Eldrin, I hope you got your answer. This question is again by Tan. So Tan's follow-up question is, so can I safely say AI and ML are good for risk management?
I'm sorry, can you repeat that question?
The question is, so can I safely say AI and machine learning are good for risk management?
Yes, definitely. Yeah, that's, I would say, is the best use of machine learning. Okay. Risk management and portfolio optimization.
Okay. There is a question by Thomas on CPO. So Thomas asked, what is the highest resolution or time frame for CPO?
Well, the maximum, sort of the frequency depend on the frequency of your features and the frequency of your return. So, if you, for example, want to optimize your portfolio every hour, you would need features that changes every hour. Otherwise, if you want to optimize your portfolio every month, you might be able to tolerate features that only updates every month.
Okay. There is a question. There are actually two questions, back-to-back question from Ashraf. So Ashraf asks, is there a best use case for RL within any type of trading while getting explanations for why a certain decision has been made? And in other words, do certain types of trading better treated as optimization problem rather than prediction problem?
So let me first put out a disclaimer. I'm no expert in reinforcement learning. I have heard good things about it. I have no first-hand experience whether it works or not work. I understand that high-frequency traders like to use reinforcement learning to simulate the order book, because frankly, when you are at that level of frequency, it's almost like playing a game with the opponent. So reinforcement learning might work better than traditional supervised learning algorithm. But that is, hearsay. I do not have any expertise or direct experience with it.
Fair enough. So I hope you got your answer, Ashraf. Uh, this question is by Darshan. Darshan asks, there is a new concept called auto ML, which is not exactly same as AI. If you are acquainted with it, could you express your ideas on auto ML in finance?
Well, auto ML is nothing particularly new or innovative. It just means that there are a lot of things in AI that require trial and error. For example, hyperparameter optimization or model selection. So auto ML basically just automate all these parameter optimization, whether it's a hyperparameter optimization or model selection. So for example, if you want to say, hey, is a neural network better for this problem, or is it a random forest, or is it a support vector machine? Well, auto ML would just try one after another and tell you and pick the one that has best performance and select that as the model. It's just a software layer that makes it more efficient to run an AI program.
Okay. The next one. This is from Srirang. How to find regimes and regimes changing with the help of AI and machine learning. How to improve Sharpe ratio of strategies.
Well, that is all done implicitly. So again, these regimes are not identifiable. You cannot say, oh, right now AI is predicting this is an inflationary regime. The regime that we're talking about is much more subtle. It is, you might call, a hidden regime. It has to do with, okay, we have a context of an inflationary economy. We have high interest rate. We have oil prices that are, very volatile, and we have we just in a bearish market. This is many variables that define this hidden regime. And so we are, however, using this implicit regime prediction to aid in predicting whether your strategy is profitable. So we don't directly need to predict it, because it doesn't help you to directly predict that regime, unless you're predicting, this is going to be a bear market. If you can predict that kind of explicit regime, my goodness, like I said, you should immediately retire. We can't. And so when we are talking about hidden regime prediction, just like in the traditional hidden Markov model, you don't care what the regime is. You don't give it a name, because what you want to do is not to predict the regime, but is to use the predicted regime to aid in the prediction of something that is useful to you, such as returns.
Okay. Yeah. So I hope, Srirang, you got your answer. The next question is by Dan Martin. So if systems that use price alone and technicals based on the price often fail, what are the most important features to add?
Well, everything is the simple answer. Everything you can get your hands on. Inflation data, oil data, implied volatility, options, bond data. If you have a $1 million, spend the whole $1 million, and you will get all the data. It's just just exhaustively collect as much weather data, climate data. You have it, freight train data, just war data, whatever you can get your hands on, put it in your model. That is the beauty of machine learning.
Okay. Now the next question is from Ayan. So Ayan Yuxel asks, do you describe your approach as forecasting or now casting the regimes?
Definitely, it's a forecasting.
Yeah. Can you elaborate on this, on how you put in-outs and target variables for your model?
Well, it is still within a supervised learning context. So the target variable typically is future return, or future Sharpe ratio, right? And you're trying to predict that, to be precise, these are returns or Sharpe ratio of your strategy, not of the market, not on the stock, right? And the predictors are, as I said, anything you can find, contemporary variables, including prices, including returns, right?
Okay, okay. Now this one is from Huima. Is there a hands-on demo for Corrective AI SaaS?
Yes, our website has demo, has free trial. You please feel free to sign up for a free trial. Yeah.
Wonderful, wonderful. And I think we are also getting a lot of questions related to career and career development. And so this question by Yugandhar. So Yugandhar asked, I built algo models and these are in testing for last 6 months, but I don't know how to raise funds and venture capitalists for this new fintech startup. Could you guide him?
Well, venture capitalists are typically not interested in algorithmic trading models. However, hedge funds might be interested in it, so you should privately approach various hedge funds and demonstrate, put together a pitch deck with your track record and so forth, and see if they are interested. If there are 100 hedge funds in the world, you contact 100 of them. And some, maybe one of them will answer, and we'll take a closer look at your track record. Yeah, so the important thing is that you have a live track record to demonstrate your success, and hedge funds are interested in that. VC, on the other hand, are not interested in the past. They're only interested, in your future, how scalable it is, and generally they're not interested in trading strategies.
I hope that's some guidance for you, Yugandhar. Okay, and I am also, so I have parked a lot of career specific questions. So I think we will be running out, like we are running out of time already. So one last question, and that will be for a generic question from my side to all the aspiring quantitative traders or algorithmic traders who have joined us here today. So Dr. Chan, I know I have seen a lot of your videos where you have guided a lot of people. So, any word of wisdom for people who are just starting off with algorithmic or quantitative trading, and like a piece of advice that can help them?
Well, I think on one hand, one should read as much as possible and take courses like in QuantInsti, and on the other hand, we should roll up the sleeve and backtest, and even more important, trade live. There's nothing more important than trading live to gain intuition about the market. So yeah, just no amount of reading or backtesting will help you with that. So I think that to me, that is the key transition from being an armchair trader to a real trader.
Thank you so much for this piece of advice, Dr. Chand. And to everyone whose questions were not answered, we are still getting a lot of questions. So I would suggest that right after this session, you will be getting a survey. So please make sure that you are putting your questions there. We'll make sure that all of your questions are answered. And with that said, I would again like to thank Dr. Ernest Chan again for joining us here today and sharing his work and experience and knowledge. I think it was really amazing. And on 27th of September, we are celebrating our 12th anniversary. And Dr. Chan has been always here for us since quite a long time. And thank you so much for all your guidance, Dr. Chan. And we look forward to continue hosting more such wonderful public sessions with you. Thank you so much.
Thank you very much for inviting me. It's my pleasure.
Okay. And to our audience, now for the fifth and last session of the day, how to lose money trading options. Now this is going to be a very interesting session. We'll be joined by Dr. Ivan Sinclair from Chicago, United States. So stay tuned, and I will catch you in the next session in next 15 minutes.